Some people might imagine trading being this effortless way of constantly getting easy money flow. The only thing you have to do is some mouse clicks to buy and sell some company shares and collect the profits. Nowadays, you can even trade on your phone. Or an even better way, write some script and let the computer trade for you while you're on a vacation. Then 6, 7 or 8 figure sum is magically transferred to your bank account. At least that's the dream sold by a lot of trading influencers and gurus in social media. However, when one decides to actually try trading, they quickly realize that this isn't as easy and it may cause you to lose a lot of money very quickly. In this video, I will show you truths about trading, and I had to learn the hard and painful way. I hope you can take something from this video that may save you some time, money or pain, because these common situations apply to almost all traders. Many people are lured by trying to figure out the market. I thought I have to learn everything I can as fast as I can to become better at reading the market. Thus, I started my research on what people were suggesting one needs to know. Vague things like have a good strategy, understanding order flow, price action, price patterns, indicators, trend following, balanced auction, volume profile, liquidity grab, etc. If I knew all that and more, I'll find a way to predict the next market move with certainty. I wish that was the case. As everybody else, when starting something new, we have no idea what we are doing, what are the fundamentals, what is necessary to know and learn. In trading especially, it's uncharted territory for the most part. There is no predefined best way on how to learn and what to learn and in what precise order for that matter. We are living in an age of abundance of information everywhere on the internet, and that is an amazing thing on itself. But you can also get lost quite easily searching for what you need and what is valuable and key information for you at that moment. After doing thousands of hours of research by reading forums, watching videos, and multiple courses, spending money, time and effort, I realized that I need to develop the so-called trading edge. That will give me winning chance in trading the markets. But what exactly does constitute a market edge? I had to dive deeper into what this actually means to understand it and to be able to create such a thing myself. After 2 years of serious work, seeking all that and more, now I'm coming to the conclusion that edge, in a sense, is something unique to oneself. It is a sum of our own dedication, work, process, development, and experience thus far. The market works in the same way, as it is the summary of all the participants who go through the same journey, but it takes different amount of time for everybody. As humans, we are all evolving, and if you do not change and stay stagnant, your edge will erode. The strategies you use will stop working eventually because the market has changed. The trader's edge lies in applying his own understanding, execution, and preparation. Emotions. It's not you against the market, it's you against yourself. Developing edge is the hardest part. After that, trading becomes easy, right? Wrong. Sadly, it's not working like that. Even if you have a robust strategy, methodology, practice, backtesting, forward testing, enough relevant data, all of that looking so promising, there will be days where you might not feel that well, or you're sick, you might have a heated argument with someone, or you just haven't slept that night, being tired. At some point, when you're the least expecting, those factors will cause you to become emotional. Your judgment becomes clouded. Critical and rational thinking vanishes. That's the perfect storm, and when that occurs, you will make stupid decisions that normally you would know are making no sense. That will degrade your performance enormously. Your P&L suffers. The progress which took you so long may vanish in just a few hours or days. Fear of losing, greed, FOMO, revenge trading, impatience, boredom, ego, the need to be right. Those force three major trading errors, moving stop losses, becoming too greedy on a trade and not taking profits when you have to, also being too hesitant to enter a valid setup and thus missing a potential winner. All those factors cause realized losses and missing unrealized profits. The painful memory of those events can pile up in such a degree that it will trigger a vicious down spiral that becomes almost impossible to escape from. Then you lose confidence in your own ability and edge application. It became clear to me that I have to take emotions very, very seriously. They are detrimental and they could force me to initiate my own downfall. I am planning to do separate videos on the topic of emotions, where I could break down in details each major one and the consequence of them. There's a domino effect where one small mistake, and if you don't catch it in time because it's so subtle and happens fast, errors become apparent and emotions start kicking in. The rational mind becomes hijacked and you can't think clearly anymore. In this environment, things can spiral out of control very rapidly, and before you fully comprehend what is going on, your account has taken a huge blow and you start feeling desperate. The bad thing is that this cycle can reoccur over and over and over again. That's why emotions are the biggest area of improvement for us traders, as we are working on developing our market edge. Because without proper emotional intelligence and control, one might have the best strategy, but it won't matter because he would be unable to properly execute it. Market behavior. In a nutshell, the market only does three things: trend up, trend down, and range bound auction, also called a consolidation, where buyers and sellers are agreeing temporarily that these prices are fair. Sooner or later, the price action breaks out of its consolidation and starts new trend. There are nuances in trends where the market has stronger directional move with almost no pullbacks. On the other hand, on weaker trends, we can see opposite orders being able to deeply push back the prices. This knowledge will come to you with more experience and observation on your specific market. In addition to that, consolidation areas could also vary in volatility. When you see prices spike up or down quickly, or when the markets will stay quiet in a small range waiting for important news release. Most of the time, about 80% price action is taking place in a consolidation area, and the rest 20% is either trending up or down. The higher the time frame, the more important it usually is, as market participants with bigger positions look at the daily chart rather than the 1 minute or 5 minute charts. They stay in the market for longer periods, usually months or even years. Our job as traders is to have specific zones of interest where the market might give us a clue of its current momentum and strength. If it is respecting both resistance and support, then we are more likely to be in a range-bound price action. If it breaks a key zone, then use that as a catalyst for a move, then we might be in a new trend. With that, ideally, we can make better decisions as day traders. Usually, we do not want to fade a strong trend. Equally, we do not want to preempt a breakout every time it reaches a top or a bottom of a consolidation area. Breakouts require time and multiple tests before a decisive move is made. Make trading as simple as possible for your own sake. You don't need a difficult strategy that is hard to execute and easy to mess up because of complexity. One valuable advice is to do as much of the trading work before and after the trading session as you can. All the controlled decisions of daily size, risk per trade, general setup, key zones, and more ideally have to be prepared in advance. Have as little choices to make during the trading session as possible. In example, know your setups well, so when they appear, you can quickly decide if it checks all the criteria you have set them to do. Moreover, the size of your position should be predetermined. Know your stop loss area when your trade idea is no longer valid. With more experience and data gathering each day that's set up in different conditions and scenarios, you will become more comfortable and know when your trade is more likely to work or not. Another important part is having general idea of where your entry should relatively be, to have the best likely risk-reward factor and to keep losses to a minimum amount. During the trade, just observe what clues are presented by the market and make mental notes of them. Write them down after your trading session is complete. For example, is this trade looking like it's working, going in your direction as you expect it to be? Keep that position, because the odds of working are higher. Is it going against you? With no one seeming to defend those prices, consider getting out. Keep the winners for longer and cut the losers fast. I know it's easier said than done, but with more screen time, you'll start to catch those little nuances and develop a trading intuition, which will guide you, but only after sufficient knowledge and data has been gathered. It's a constant pursuit of getting better at it, and with time, we do learn. Risk management. Capital preservation is priority number one, to survive long enough till all finally starts clicking in. Without the necessary capital, we cannot trade. It's our lifeblood as traders. In gamers' term, it's our character's HP. In trading, you just cannot go wrong with a very strict risk management. Extremely vital in the beginning in your career, when you're still getting a grasp of market environment and price action. You'll have to do some math yourself after getting enough data to be more precise in terms of risk. In general, you shouldn't risk more than 5% per single trade, maximum of 10% if you have a small account size and want to grow it faster, but it's also riskier. As your account is getting bigger size, you would want to lower your overall risk exposure to 1 to 3% per trade gradually. That way, you would almost guarantee that the account isn't going to be blown because of an unlucky 5 to 6 losses in a row, which do happen. If you blow an account, it's game over. Do not allow that to happen. There are ways to never ever lose an account. As long as we are rational, stick to a plan, have a strategy and define risk, and execute upon it, it becomes more likely to keep an account long enough till we start growing exponentially based on the acquired skill set and experience. But do make sure to learn from each mistake on a daily basis and distance yourself away from repeating that. Find your own ways to protect you from becoming irrational and a danger to your own capital. If you're new to trading, do paper trading. Learn limit versus market orders. Learn OCO orders. Make strategies using different types of those orders. See what sticks and works best with that specific strategy. For instance, during a range-bound price action, limit orders are a great way because they force you to wait for a better price entry around the extremes of the range and fade it if that's your style. If we are in a trending market environment, it might be a better option to be more aggressive and use market orders for an entry, because the market might not return back to those prices during the day. These are general examples and are subjective, but hopefully you get the idea. If you've reached to the end of the video, thank you, and know that you've already put more effort than 95% of people, and at the very least, you're on your way of achieving the success you're looking for. Don't quit yet. Mistakes and failures are the building blocks to success. Only after someone decides to quit, then they accept defeat.